I'd like to welcome Scott Williams. Scott is an Associate Director in PwC's Sustainability and Climate Change Department. Scott's area of focus and expertise are sustainable development assurance and integrated reporting. In addition to having 10 years of financial assurance experience, he has performed numerous SDA and IR engagements across the mining, financial services, and telecoms industries, thus providing him with a very strong assurance credentials and knowledge of sustainable development-related matters. So good morning and welcome, Scott, and thank you for taking the time to join us this morning.
Morning, Loshni. Lovely to be with you.
So this morning, we're going to chat to Scott about what buyers of sustainability assurance should know. So let's start with trying to understand what sustainability assurance is. Scott, could you share some examples of the various types of assurance engagements that exist to help us understand this whole concept of sustainability assurance?
Sure. So I think some of the most common types of engagements that we have relate to the assurance of various key performance indicators for JSE listed companies or companies listed elsewhere. Looking at essentially key performance indicators which are important to them, their business and the industry that they're in. So in a South African context, it could be transformation statistics, could be KPIs around health, safety, corporate social investment type spend, education and training, amongst others. The list is very long indeed. And we can also assure alignment with specific frameworks, depending on the industry that the client is in. For example, the ICMM principles of responsible mining might be an example. In the banking sector, Equator principles for the type of investment in carbon or non-carbon intensive industries, etc. And also in terms of responsible sourcing, so precious metal refineries, most of them are aligned to an industry body who requires them to demonstrate that their supply chain is free of conflict minerals, for example, amongst other things, and we can provide assurance on management's compliance with that as well. So they are some of the most common ones I deal with. There's a wide range of other topics as well where we provide assurance.
Thanks, Scott. So Scott, you've mentioned frameworks and you've mentioned various KPIs, but what I want to understand is, how is assurance of sustainability information different from the audit of financial statements?
So there's quite a few differences. The first thing is that we don't have an equivalent of IFRS, where it's once, or US GAAP, where there's maybe one or two sets of universal standards which companies apply or have to apply from a financial reporting perspective, and that's what the audit is based on. The KPIs, for instance, that we could assure, they could be driven by global frameworks. They could be equally completely designed by management of the company themselves with their own definitions, because there is no requirement to comply with a specific framework. So yes, another key thing, which is maybe a difference from financial audit, is that the scope of the assurance work is determined by the client. It's not an IFRS financial statement audit, so the scope could be extremely big, it could be small, it could relate to a very narrow scope of indicators, it could be very broad across different facets. That's really determined by the client, because there's no regulatory requirement for sustainability assurance. Also, there are two levels of assurance which are available for sustainability assurance. You can have limited assurance and reasonable assurance. So it's not just one level of assurance or that we would see in a financial audit typically. So there's some of the key differences.
I've heard the words audit and assurance being used interchangeably. What is the difference between these two concepts?
So I think from my perspective, audit is very much the way I look at it is the statutory requirement for an audit. So in South Africa, that's determined by the Companies Act, your statutory audit on your IFRS financials using the international auditing standards. Assurance, sustainability assurance, as I said, it applies audit type principles. In fact, the methodology we use and the testing procedures are akin to what you would do for financial audit. But as I said, the scope might be quite a bit narrower. It's not a regulatory requirement. So that's the distinction that I make as well.
Thank you for that, Scott. So Scott, why would a company consider assuring their sustainability?
Maybe the best way I can explain that would be through an example. Mining being a key industry in the South African economy, and safety being a key issue within the mining industry as well. All of the mining companies within the South African space dedicate a lot of time and resources to mining as safely as possible. They want to avoid fatalities, and they certainly want to avoid as many injuries as possible as well. So if I am someone in a governance position in that company, I want to make sure that the efforts that we are putting in are yielding results in terms of safer mining. So assurance of your lost time injury frequency rate, ratio, or even your fatalities figure, which we all hope is zero, adds credibility to the numbers that are being reported. So it allows you to assess with more credibility on the information, is what we're doing sufficient, and is it making a difference from a safety perspective in this instance? And also, if you look at a mining company, incentives and bonuses, right from your shift boss going underground to your CEO, quite often have an aspect of being related to safety performance as well. So we want to make sure, are we paying bonuses? Are we giving incentives on credible information from a safety perspective? So that's an example of why I think it's important, is that overall credibility of information, and that the information that management and those in governance are using to make key decisions, that it has that higher level of credibility because it's been through the assurance process. And also stakeholders are demanding it. We've seen stakeholder activism among, and also various groups of stakeholders across companies demanding integrity of the information that they're being given. So that's why sustainability assurance is so important in my eyes.
Thank you, Scott, for putting that into perspective. So you mentioned earlier a few frameworks. As I understand, there are different types of assurance using a number of assurance standards. So the one that I actually want to focus on is assurance engagement based on ISA 3000 revised. And there are a couple of elements that I just want to pick up on. And the first one being rational purpose. Could you expand on that for us and explain the importance and why it is something that companies should be considering and thinking about? And then we'll look at the other elements after that.
Sure, thank you. Absolutely. So rational purpose really speaks to the scope of the assurance engagement. As I said previously, the scope is determined by the client. So it's quite unique when you compare it to financial audit, for example. So rational purpose for me, in its simplest way, speaks to not just considering what is in scope, but what not has been put in scope for assurance. And does that make sense? And would it be in line with the expectation of various stakeholders? So again, maybe an example is a good way of putting it across, perhaps this time from the financial services industry. So if I'm a bank, my day-to-day operations, yes, they create greenhouse gases, but they are not massively carbon intensive when you compare it to heavy manufacturing or mining, for example, or energy and oil and gas. If I have my own carbon figures, my own greenhouse gas emissions assured, that's great. And obviously you're using that information to monitor and reduce your own greenhouse gas emissions over time. But really a key thing might be, what kind of projects am I investing in, and what is the carbon implications of those? So am I investing in fossil fuels mainly, or am I investing in renewable energy type projects? And that would be a key thing for me to be assuring, because finance institutions with their lending policies and their lending practices really drive other industries' ability to operate. And if it's carbon intensive industries, then that's something which has an environmental implication. So in that instance, it might be a good thing to have in scope something around the Equator Principles framework, which is around how financial institutions carry out due diligence and assess the environmental impacts and social impacts, for that matter, of the projects they invest in. So that's something that maybe would be in scope when you have your rational purpose hat on.
So, Scott, when an assurance practitioner talks about criteria and subject matter, what do these two concepts mean, and how do they relate to one another?
So at its simplest, subject matter is the underlying phenomenon which is measured or evaluated. So that could be your, as an example, your number of, or your percentage of previously disadvantaged South Africans at a specific management level is an example of a KPI. The criteria is then providing the detail of how that number is calculated or arrived at. So what is the definition? What definition are you using of previously disadvantaged South Africans in this context? What is management? Are you using a global framework to determine who is management position and who is not, or is it an internal based on the description of your own internal hierarchy and positions? So that would be the criteria, is the detail of how you actually get to the figure which you are reporting, which is your subject matter. And when you put those subject matter and criteria together, that comes to the subject matter information, which then appears in your report. A key thing, just maybe for users of reports, is that those criteria that you apply, while they and often are internally generated, there's certain aspects that those criteria have to embrace, which would be completeness, understandability, neutrality, reliability, and relevance. So you can't just put anything there. For example, if you said the number of previously disadvantaged South Africans in senior management, but your definition allowed the inclusion of white senior management and also people who are at the lowest level in terms of your hierarchy, that would not make sense. So when the assurance provider is thinking and applying their mind to those criteria, that's something that would be definitely pushed back on if we did not think that it met those specific aspects that I've just listed there. And also the criteria that management is using should be very easily accessible by users of a report. So it shouldn't be buried beyond link and link and link and link and link. It should be very clear where those criteria are for a report user, an integrated report or a sustainability report user, and they should be set out very clearly, and they should be understandable to people so they understand exactly what criteria has been applied by management.
Okay, thanks for clearing that up and putting that into perspective, Scott. So, Scott, could you take us through what a typical assurance process looks like?
Sure. There's definite similarities with financial audit in that we have a planning phase, a fieldwork phase, and a completion phase of the engagement. From a client's perspective, the main initial activity that they would see would be our meetings regarding the systems, processes, and controls as they relate to the KPIs in scope for assurance. That's where we would start with the client. There's obviously internal risk management, etc., that goes on with any assurance or audit engagement within a firm. But from a client perspective, that's what they would see first. We would ask for those meetings. We would ask those key questions to understand what happens in the organization as it relates to a specific KPI or set of KPIs, and drill down into the controls and systems and evidence that we might even get as we go on to do the assurance procedures. And then we would flow into the evidence gathering and testing phase, where we would obtain perhaps detailed listings, picking samples, requesting evidence for those samples, and also doing kind of overall high-level analytical procedures, more from an overall sense check type perspective as well. Going into the completion phase, that's where we are looking at essentially reporting being the main thing that a client would see.
Scott, would you mind highlighting some areas within this process that a company should be aware of that might pose some challenges for them?
Definitely. What I would say is, having had a lot of experience of financial audit and sustainability assurance, I would say that the control environments and processes in general, and obviously there's exceptions across the companies that I've seen, for sustainability type information are not as advanced or robust as those for financial information. And that can lead to difficulties. For example, one of the key things that an assurance provider is likely to ask for a specific KPI is a detailed listing of the information that makes up that KPI. Now, in some organizations that can come from different operations, who run different systems and have different ways of doing things. So trying to pull all of that information together into an understandable format to then continue testing can be one of the biggest challenges we face. And also, whereas an organization with multiple operations from a financial perspective might just use SAP or Oracle across the board, it could be quite different, and the systems and processes and controls across different operations could be marked, could have marked differences, which means that the type of information and evidence we can get could be very different, and also leads to challenges. So that would be my key area where I think that challenges can be encountered, especially in assurance engagements which are new to the client. They're first or second time obtaining assurance, for example.
Okay. Scott, you mentioned the evidence gathering earlier. So when you go to work with a client and you're starting your assurance engagement, what do you typically look for during evidence gathering? So, as a company, how do I understand what is good evidence or bad evidence? Do you have any examples that you could also share, please?
Again, it's probably quite similar to financial audit in that the best quality evidence would be, from external evidence like invoices or meter readings if you're looking at energy consumption. That kind of information is the most credible. Obviously, sometimes that is not available. It might be more internally generated information. It could even be in spreadsheets. And that would really then necessitate different types of procedures, perhaps more detail into the testing and more detailed analytical exercises to identify variances or particular numbers that would stick out and that we would need to drill into more detail for a much deeper understanding. So very similar to financial audit in that regard, in terms of the quality of evidence we would look for.
Scott, you talked about limited and reasonable assurance earlier. Would you mind please expanding on these two? And then I've got some questions around, if we start at limited, can I switch to reasonable assurance in the middle of an engagement? Or if I'm a first-time reporter, which one should I consider? Just to expand a little bit on limited and reasonable.
Sure. So the level of assurance in limited assurance is much lower than it is in reasonable assurance. It's almost, if I was to put it in an equivalent of financial assurance, it would be more akin to a statutory review type of level of assurance than reasonable assurance. Reasonable assurance being more akin to a statutory audit type level of assurance in terms of the level of detail that the auditor goes into and the level of comfort that can be derived from it. It's very difficult to switch between the two during an audit. An assurance engagement rather. The main reason someone might want to do it is that they had started on reasonable, found a lot of issues, and then hoped by going to limited that they might be able to get a clean assurance report. So really, no, it's not possible to switch between the two unless there's a very, very good reason for it, which would need a lot of consideration. And I know from a PwC perspective, we would be engaging with our risk management colleagues in detail. However, it is possible between years to change the level of assurance that you can apply. Again, that's management's prerogative. So you could go from limited to reasonable or reasonable to limited, although that is less likely to be able to do that in that instance. So yes, between years, definitely, but once an engagement has started, it could be problematic.
And
sorry, and just your other question I forgot, yes. Sorry. Yes, was just starting out. There's actually something even prior to limited assurance called a readiness review. So, and it's something I would recommend for companies who are thinking about having assurance on their sustainability information. A readiness review is really what I would call an audit or an assurance engagement light. So it's your Coke Zero compared to your full fat Coke, if I would put it that way. And that is where we would come in. We would look at a scope of KPIs and we would do assurance procedures on them and then give you purely internal management feedback. So some kind of management report saying, okay, KPIs A, B, and C, yep, based on what we've done, they're ready for assurance, but D, E, and F, you need to improve the following aspects to get those ready for assurance. So there would be no external assurance report from PwC or another firm on that type of engagement. But what it does is it tells management for perhaps the next year what might be, what's ready for assurance already and where do they have to improve to then enable assurance the following year. And in my experience, it would always be best to go for limited assurance for the first round of assurance, just because, you know, the level of detail we go into is less because it's a lower level of comfort that is given. And then if limited assurance is working well, we can talk about progressing to reasonable assurance further down the line.
I love the Coke example, the Coke Light versus full fat Coke. Sticking with limited and reasonable assurance for a moment, there are words that in assurance engagements that you come across around control and substantive testing. So what do these mean? How do they differ? How do they relate to limited and reasonable assurance?
So control testing is where we would look at what controls are in place around a specific KPI or set of KPIs that would relate to each other, and testing those controls, which could be management reviews, they could even be automated system type controls in some instances, to help us obtain the level of comfort we need. It's very unlikely that you would have control testing on its own. It would usually be topped up with some level of substantive testing, which would be your analytical procedures or testing to audit evidence like invoices or meter readings or other type of things. It might just be that if you've got significant control comfort, the level of substantive testing you do would be much lower than if you didn't have that controls comfort. My experience is that very rarely do we do a lot of controls testing and take a lot of controls comfort. It's mostly substantive testing based. However, in a reasonable assurance environment, where the client is probably asking for reasonable assurance because they've got much more mature systems and processes and controls, it is a possibility definitely to take some controls reliance based on testing performed and then topping that up with a lower level of substantive testing. But it's unique for each engagement. You could have limited assurance with controls. You can have reasonable assurance without controls. It really depends on the nature of the engagement and the nature of the client.
That's great. Thank you for helping me out with that, Scott. So, Scott, the last part of the process that you explained to us is the reporting side of it. So, from what I understand, the organization company gets a management report as well as an assurance report. Now, we've seen the assurance reports on websites or included in sustainability reports or referred to in integrated reports. Could you explain what these two reports are and what they're about, the type of information, their objectives?
Yeah, so maybe from the assurance report perspective, the conclusion would differ, the wording of the conclusion, depending on whether it was limited or reasonable assurance. One thing I did perhaps forget to mention is that the KPIs in scope don't all have to be limited and all have to be reasonable assurance KPIs. You could have a mixture of the two. So your assurance report might contain a limited assurance conclusion and a reasonable assurance opinion. So that, you know, the limited assurance conclusion is, we call it the kind of negative conclusion of nothing has come to our attention that leads us to believe. Whereas a positive conclusion is more, in our opinion, the selected sustainability information is prepared in all material aspects. That's the difference between those two. So that's how it would appear on the assurance report, which you're right, you would see on a company's website, either included in the report where the KPIs are included, so a sustainability report or an integrated report, a report to society perhaps, or it could be linked to that report and it could be included separately with a document link as well as a link to the criteria. A management report is then that confidential document which is given to management, which contains details of observations we might have from our assurance work, and also recommendations for improvements that could be made based on those observations. So really we see it as equally as important as the assurance report, because it's where we can add value and help guide management on how they can improve. And that improvement is something that then can lead to going from limited assurance to reasonable assurance, or increasing the scope of an insurance engagement to include more KPIs as the environment matures and the reporting process matures.
Thank you for that, Scott. So, Scott, a couple of bigger questions in terms of how does assurance fit within the context of combined assurance? So it's just trying to understand, the differences between external, internal audit assurance. So where does sustainability assurance fit in this whole model?
So I think when you talk about combined assurance, it's got a number of potential aspects. You have your statutory financial statement audit, internal audit would fit in there, and then sustainability assurance is another area which would fit in there as well. You might also have BEE certification, for example, which some companies fit within the combined assurance model. So as I said, sustainability assurance is well recommended by the King Code, is not mandatory. Some companies say that their internal audit over specific KPIs provides them with sufficient comfort for their purposes. Other companies use sustainability assurance like ourselves, or a combination of the two. So there's no right and wrong answer as to what a company should do. Of course, I think that the external sustainability assurance definitely has a lot of value, and the way that we do things would be quite different to internal audit, for example. But it all depends on what outcome the company is looking for as to what kind of assurance they require or that they would request within that combined assurance environment. So there's no right or wrong answer, but we definitely form part of that combined assurance environment. And really, if another analogy might be, you've got a bucket, it's the assurance bucket, you want to fill it to the top. It might be that you take 60% of that assurance comfort from your statutory audit and top it up with other things. It might be that you take less and that you would then more from internal audit in terms of your overall comfort, and it really depends on the nature of the company, and obviously sustainability assurance can form part of that.
Cool. Thanks, Scott. That puts things into perspective for me as well. Last big question. Can an assurance practitioner assure anything? So if as a company I come to you, can you assure, as an example, my entire sustainability report or integrated report, or can I give you something very weird or wonderful to assure?
So at the moment, we don't assure any full reports. What I would say is our colleagues in the Netherlands do, but they have a specific Dutch standard which is designed exactly for them to do that. The reason that we have a challenge under ISA 3000 is that, if we were to assure a whole report, that would mean assuring very subjective, process-related, narrative, qualitative information, which can certainly present challenges. And it might be that the evidence to substantiate narrative or qualitative claims in a report or assertions made by management simply isn't there to enable us to provide assurance. What I would say, though, is that the IAASB currently has an expanded external reporting project on the go, and we can definitely see that the movement is towards assuring, if not whole reports, whole sections of reports based on potential revisions to ISA 3000 or additional standards coming online. So at the moment, from my perspective, no, we wouldn't assure a whole report, but watch this space. Over the next few years, there's going to be a lot of movement.
Scott, last question. So any last pieces of advice for organizations thinking of external assurance, or those who are currently doing this for a while? Any last pieces of advice?
Definitely. So for companies who are thinking of seeking assurance for the first time, I would say it's not something to be scared of. Don't panic. The concept of a readiness review, like I mentioned previously, means that you can see, are you ready for assurance, without having to worry about qualifications all over an assurance report. Let's see where you are at the moment and build towards assurance. And any assurance provider will want to go on that journey with you over a number of years. So definitely, if you're thinking about it, I would say go for it. Get in touch with us and we can help you. For companies who already have assurance and are thinking about how to move forward in the future, I would say rational purpose, while it's an assurance term, is definitely a great hat to put on and thinking, what are we assuring? What are we not having assured? If we're not having certain items assured because we don't think the data is ready, let's think about a plan to remedy that over a number of years, and we can get to a broader assurance scope and one that fulfills the requirements and the needs of more and more stakeholders. They would be the two pieces of advice I would have.
Apologies, Scott. I know I did say that was going to be the last question, but we do have one more question from the audience, if you don't mind. So the question is there a self-review threat when the assurance practitioner first provides management with the pre-audit and then provides assurance the next year?
No, it would only cause a threat if we gave very, very specific recommendations and then really helped you to implement those recommendations. That would create the self-review threat. By doing a readiness review where we say we have done work on the following KPI and we have the following recommendations which management should consider, it's then very much up to management whether they consider and go forward on those recommendations or not. That's really entirely up to them. So that's why there wouldn't be a self-review threat in that instance.
Scott, thank you so much for taking time this morning, joining us and answering our questions. The information you've shared has been really valuable and very useful, so thank you again.
Thank you very much, Loshni, and really appreciate the opportunity. And thanks again.